Now, friends, thank you once again for tuning in to this session today. Today, we are still winding up in respect to the pile of paper. And this session today, we are looking at financial reporting, the pile of paper that was set in September 2015 for the purpose of reflecting what should happen in the new syllabus. We have been looking at question 1 from the first session, and the second session, question 2, question 3, and question 4. So today, we are looking at the final question, question 5. Now, in question 5a, explain the fair value. So what I'm saying is that today we are doing a FR pile of paper that is September 2015, that is FR, or I'd say that. So we are talking about question 5. In question 5A, explain the fair value model of accounting for investment property as per IAS 40 investment property. Okay, when we talk of the fair value model, we are looking at the price or the amount at which an investment property can be exchanged, where the willing buyer or the willing seller can exchange an investment property. That's the fair value. And any changes in fair value should be adjusted to the profit or loss. That is what we have as the fair value model. Now, remember, we are saying question 5a, explain the fair value model of accounting for investment property as per IAS 40 investment property. Now, remember, investment property is initially recognized at costs. This is the transaction costs, which includes, many other expenses. We are talking about maybe normal losses and what have you. But now, in subsequent period, the investment property is remeasured at fair value. Fair value being the amount at which an investment property can be exchanged between a willing buyer, a willing seller at an arm's length transaction. And any changes in fair value at one point in time, either being a gain or a loss, will be recognized in the profit or loss for that particular period. So, friends, that's simply what the fair value model entails in respect to investment property, IAS number 40. Now we look at question 5b. The following information was extracted from the books of the Ministry of Tourism for the fiscal year ended 30 June 2015. We have accumulated fund, cash and cash equivalent, receivables, inventory of consumables, transfers from exchequer, fees, fines and licenses, liability for long-term benefits, long-term borrowings, finance costs, supplies and consumables used, wages and salaries, other expenses, transfers from other ministries, transfers to other ministries, computer equipment, vehicles, land and buildings, revenue from exchequer transactions, other revenues, payables, reserves. Required 1. Statement of financial performance for the year ended 30 June 2015, and Roman 2, statement of financial position as of 30 June 2015. Now remember, from the required point of view, the required Roman 1 is the statement of financial performance, and that's like our income and expenditure. We recognize the incomes, we less the expenditure, and whatever we get there is either surplus or a deficit. Then start of statement of financial position as of 30 June, we recognize the assets and current assets, and then equity as well, and reserves. Then we look at these items one by one. We analyze it before we do it. Accumulated fund, that is part and parcel of the finance by. Cash and cash equivalent is a current asset. Receivables is a current asset. Inventory of consumables, that's a current asset. Transfers from exchequer, that's an income. Fees, fines, and licenses, Remember, the government or the ministry will always have the main source of revenue as fees, fines, and licenses. Liability for long-term benefits, that's a current liability and non-current liability. Long-term borrowing, non-current liability. Finance costs, that's expense. Supplies and consumables used, that's expense. Wages and salaries is an expense. Other expenses is an expense. Transfers from other ministries, that is an income. Then transfers to other ministries, an expense. Computer equipment is an asset. Vehicles is an asset. Land and buildings is an asset. Revenue from exchange transactions, that's an income. Other revenue is an income. Payables is a current liability. Reserves is part of equity. And that's it. So without wasting time, we prepare the statement of financial performance. So we are looking at question 5B. Ministry of Tourism. Statement of financial performance for the year ended 30th. So we start with the incomes. One of the incomes, friends, is transfers from exchequer. $1875. Fees, fines, and licenses. $375. Transfers from other ministries. That's 7,500. Revenue from exchange transactions. $75,000. Revenue from exchange transactions. We have said that. Other revenue. So we don't have any other incomes, as I can see. Now we get the total. That will be our total income. Then we less expenditure. One of the expenditure is we have supplies and consumables used. Supplies and consumables used is 300,000. Wages and salaries. $750,000. Other expenses. $900,000. Transfers from other, we have transfers to other ministries. Transfers to other ministries, 375. We have other revenue, nothing else. I'm saying we only have transfers. We have finance costs. I've not recognized finance costs. Finance cost is something to do with 75,000. Supplies and consumables used, we have recognized that. So, wages and salaries, that's okay. Other expenses, that's okay.